Hi, Flagstone community. This is Dan Staus, lead wealth advisor at Flagstone Financial Management. As inflation continues to be high, we're still getting questions about I bonds, which has gained a lot of popularity in the past year or so with high inflation. So, thought that we'd record a pretty brief video about the features and our thoughts on I bonds. So, to start off, they have a variable interest rate that adjusts every 6 months. Right now, for bonds issued between May and October, you'll earn 9.62%. Again, it's variable. If inflation cools down, the interest rate will also go down. They have to be kept for at least 12 months. So you can't buy an I bond and then cash it out 6 months later. You have to hold it for at least 12 months. And if you do cash it out before 5 years, then you have to pay a 3-month interest penalty, which isn't terrible. It's not, it's even better than some CDs, but it is something to keep in mind. And then you'll earn interest for up to 30 years if you hold the bond that long. You buy them from treasurydirect.gov. It's kind of a clunky website. We've heard it's not super user friendly, so you need some patience and you need some technical knowledge to set up a profile there and purchase I bonds through Treasury Direct. You're also limited to $10,000 per year per taxpayer. There is kind of a loophole. If you're anticipating a tax, or if you're getting a tax refund, you can actually apply a refund towards the purchase of $5,000 more per person per year. So you can really get $15,000 a year if you have a tax refund. So are they appropriate? What do we think about them? We don't think they're great for the long term because it's a variable interest rate. Hopefully inflation cools down. So it's a really low risk, low return vehicle for the long term. We think there's better alternatives for long-term growth. It's also not great for money that you might need in the next 12 months. So whether it's emergency fund money or money that would be in a checking or savings account, even a money market account, not a great alternative or not great use for that type of money that you want to have liquid. What it can be good for is an alternative to CDs. So CDs between like 1 to 3 years, for example, you might consider I bonds instead. You need to keep in mind that 12-month minimum and the 3-month penalty. But again, that's not vastly dissimilar from a CD. And as the interest rate on I bonds adjusts, you can continually evaluate whether you want to hold them. So 2 years from now, if inflation is still really high, well, just hold on to it. If inflation has cooled down to 2%, well, you can get rid of it. But what we do know is that right now, the interest rate's 9.6%. So that's pretty strong for the short term. Again, I would just caution you to use money that you won't need for the next 12 months and money that would otherwise be in a CD. That's kind of a good use for it. So if you have specific questions about your situation and you want our thoughts on whether they're appropriate for you and you're a client, we'd be happy to talk with you. Just let us know that you're curious. If you're not a client and you have questions, we'd be happy to talk to you about what it would look like to work together. Thanks.